Hey, welcome to The Explainer. Today we're jumping into a really important topic, a silent threat to your wealth, currency devaluation. It's this hidden force that's constantly chipping away at your savings and what you can actually buy. But don't worry, in this explainer, we're going to show you how to spot it and, more importantly, how to build a real fortress around your portfolio to protect it.
Okay, so let's just dive right into this quote because it's the absolute core of our whole conversation today. The cash we work so hard to earn, well, it's actually designed to lose value over time. So the game isn't just about stacking up more paper money. The real goal is to convert that cash into assets, things that can hold or even better increase their value. That's the big mindset shift we need to make to protect our wealth for the long haul. We've set this up to be a complete masterclass. First, we'll get into the why, what devaluation is and how it really works. Then we'll learn how to spot the warning signs before it's too late. After that, we'll jump into the practical stuff, hard assets, financial tools, and even some advanced strategies the pros use. And to finish, we'll pull it all together so you can build your own personal blueprint. By the end, you're going to have a full framework you can actually use.
Okay, so first things first, we have to understand the enemy. Your money is being silently eroded, and it is absolutely crucial to know why. And listen, this isn't some abstract economic theory you'd hear in a classroom. This is a real process that directly affects your ability to buy everything from your groceries to a house in the future.
So what's the main engine behind this? Well, you might hear it called monetizing the debt or increasing the currency supply, but the official term is quantitative easing or QE. They all mean the same thing. The central bank is basically printing money. Here's an easy way to think about it. Imagine you have a pot of soup. Now, you could add more meat and vegetables to make more, right? Or you could just add more water. QE is like adding water. You get more volume, for sure, but the soup gets weaker. The value of every single spoonful goes down.
Now, here's where it gets really interesting. This slide shows how there's this hidden transfer of wealth that happens during inflation. If you're a saver and your wealth is in cash, you lose. That $100 bill you have buys less this year than it did last year. Simple as that. But if you're a debtor with a fixed-rate loan, say a 30-year mortgage, you actually win. The amount of your debt stays the same, but you get to pay it back over time with dollars that are worth less and less.
And this isn't just some theory, okay? This is a really powerful way to visualize how extreme this can get. Imagine you took out a $100,000 mortgage years ago. Now, after massive runaway inflation, that same amount of money is the new price of a single banana. You could literally sell one piece of fruit and pay off your entire house. It's a wild example, I know, but it perfectly illustrates this principle of paying back old debt with new, completely devalued currency.
This all leads to a fundamental law of human behavior called Gresham's law. It's simple. Bad money drives out good. What does that mean? It means when people have two different kinds of money, they will instinctively hoard the one they think is more stable and valuable, the good money. And they will try to get rid of the bad, devaluing money as fast as they can by spending it. It's just a natural self-preservation instinct.
So, how do we see this coming? I mean, we can't just wait for the price of bananas to hit 100 grand, right? We have to be like detectives and look for clues. And these clues pretty much fall into two main categories. You've got the fundamentals, which tell us what is likely to happen, and then the technicals, which help us see when it might be starting to happen.
And this right here is the crucial point. It's this powerful combination. One isn't better than the other, they're a team. Fundamentals give you that big picture story, the whole economic narrative. And technicals, they're like reading the market's body language. They give you clues about timing and help confirm if the story the fundamentals are telling is actually starting to play out.
So the fundamentals are these big picture forces. We already talked about quantitative easing, money printing, but we also have to watch government policy decisions, rising national debt to fund massive programs, and even long-term trends like demographics. Think about it. An aging population means fewer workers are supporting more retirees, and that can really strain an economy. These are the powerful undercurrents, the why behind a currency's potential fall.
And this is a brilliant illustration of the when. Technical analysis is all about looking at price charts, and these specific visual patterns, they have names like a head and shoulders top or a descending triangle, they can act as an early warning system. When you start to see these patterns forming on a chart of the US dollar index, which, measures the dollar's strength against other world currencies, that's a technical signal. It's a hint that the devaluation story the fundamentals have been telling us might be starting to happen right now.
Okay, let's talk solutions. We get the problem. We know how to spot it, so what do? We start by trading our depreciating money for things that hold value. We start with hard, tangible assets. We start by owning what's real.
Real estate has been a classic hedge forever, and for good reason. Unlike stocks or bonds where you're just a passive owner, real estate gives you a unique level of control. Something like a multifamily apartment building is especially strong because you can adjust the rents to keep up with inflation. Plus, you get tax advantages like depreciation, and best of all, you can actively force appreciation. For example, you can take a dated kitchen, renovate it, and directly increase that property's value and how much rent you can charge, totally independent of what the market is doing.
Next up, commodities, especially precious metals like gold and silver. For literally thousands of years, they've been seen as a store of value. But what's really key here is their relationship with the dollar. I want you to think of gold and the dollar as being on a teeter-totter. When the value of the dollar goes down, the price of gold tends to go up. And here's a crucial point. A company can go bankrupt, an institution can fail, but gold is an element on the periodic table. It can't go to zero.
Now, the newest player in the hard asset game is cryptocurrency, with Bitcoin being the big one, of course. For a lot of investors, crypto is a hedge not just against the dollar, but against the entire centralized banking system itself. Because it's decentralized, no single government or central bank can just decide to print more of it. In that way, it's a direct competitor to gold as a modern, digital store of value. Although, you have to remember, it does come with its own set of risks, like some pretty significant price volatility.
Okay, let's shift gears now. We're moving from physical assets to financial tools you can use right inside your brokerage account. Because you don't just have to buy things you can touch, you can actually use the market itself to protect your portfolio. So a key strategy here is finding assets that are inversely correlated. All that means is they tend to zig when the rest of your portfolio zags. A classic example is the relationship between the stock market and what's often called the fear index, or market volatility. When the market panics and stocks fall, volatility spikes up, and instruments that track it, they tend to rise really sharply. So holding even a small position in something like this can be a powerful counterbalance during a big market downturn.
All right, for those of you who want some more advanced tools, let's take a look at how professional traders use options. And I want you to think of these not as some speculative gamble, but as a really sophisticated form of portfolio insurance.
This is the perfect mindset for this. It's about paying a small, known cost, what's called a premium, to protect yourself against a large, unknown loss. A huge reason pros use them is for capital efficiency. Instead of selling a stock you really like, you can use a small amount of cash to buy an option that protects a much, much larger position. That frees up the rest of your capital for other opportunities.
Okay, let's walk through a pro-level move here. Let's say you have a trade and it starts going against you, hard. A delta hedge is basically a way to stop the bleeding. What you do is you place a second opposing trade that's designed to counteract the losses from your first one. Now, the goal isn't to make money on the hedge itself. The goal is to neutralize your directional risk so that if the price keeps moving, it doesn't hurt you anymore. It buys you time to breathe, manage the situation, and decide what to do next without panicking. The collar is one of the most common and conservative hedging strategies out there. Imagine you own a stock. You can basically build a fence around it. First, you buy an insurance policy. It's called a protective put. This gives you the right to sell your stock at a guaranteed price, no matter how far it falls. Now, that insurance costs money, right? So to pay for it, you sell another option, a covered call. This brings in some cash, but in exchange, you agree to sell your stock if it goes above a certain price. See what you did? You've limited your downside risk, but you've also capped your upside gain. You've created a defined range, a collar, for your stock.
And finally, let's bring all these tools together. Look, a pile of tools in a garage is useless without a blueprint to build something. It's the exact same thing with investing. You need a cohesive plan for how and when you're going to use these different strategies.
This right here is your defensive toolkit. These are the core skills of risk management. Proper position sizing makes sure that no single loss can ever wipe you out. Stop loss orders give you a pre-planned escape hatch. Asset allocation spreads your risk across different areas: real estate, commodities, stocks. Hedging, like we've been talking about, provides that specific insurance. And finally, none of this is set it and forget it. You have to periodically review your whole plan to make sure it's still working for you. Mastering these skills is absolutely essential for long-term survival.
So here's the crucial takeaway from all of this. We are living in a time of incredible systemic change and risk. You can't control the monetary policy of the central banks, you can't stop governments from borrowing more money, you can't control the storm. But what you can, and what you must control, is the integrity of your own lifeboat. So the real question isn't whether a storm is coming, but whether your portfolio is built to weather it.